Happy Monday, everybody. Welcome to another episode and a new week of China Update, where we discuss leading political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Today's episode will be very much focused on the economy. Let's jump in. And first up, today, Monday, Beijing published official numbers for the economy, and they were not good. The fact that official data like these are this bad is in of itself very telling. China's economic momentum weakened sharply in November, with consumer spending and investment both deteriorating further, plunging to COVID-era lows. This is not good news for policymakers as they move into 2026. Retail sales rose just 1.3% from a year earlier, the weakest reading outside the pandemic period, and well below all forecasts in a US-based Bloomberg survey and UK-based Reuters survey, which had expected growth to hold steady at around 3%. The disappointing consumption data were accompanied by broader signs of softness. Industrial production grew 4.8%, marginally slower than in October. China's investment fell for a third straight month in November too. Fixed asset investment fell 2.6% in the first 11 months of the year, as the prolonged property downturn continued to drag on construction and related sectors. We will move to this shortly. Goldman Sachs analysts estimate that about 60% of the recent falls in fixed asset investment up until October were due to statistical corrections of previous over-reported data. But they said also that 40% of the decline could be attributed to a prolonged property market slowdown, infrastructure-related fiscal spending, and Beijing's so-called anti-involution policies, which economists say is usually caused by overcapacity. We've been following all of these areas very closely on China Update this year. In a statement, the National Bureau of Statistics acknowledged that the economy faced, quote, many external instabilities and uncertainties, end quote, in November, and said domestic demand remained insufficient. China's failure to reignite consumer spending, despite now years of policy to do just that, is increasing its exposure to a weaker global environment. Growth has leaned heavily on exports in recent years, but shipments are widely expected to slow next year as protectionism spreads and trade tensions intensify beyond the United States. Weak demand at home has also entrenched deflationary pressures, squeezed corporate profits and household incomes. Policymakers have pledged more proactive macroeconomic policies and have elevated boosting domestic demand to the top priority for the coming year. However, analysts say incremental measures may not be enough. Indeed, the last few years of such measures have had little effect. With real estate activity and consumption cooling in tandem, economists argue that revising the slowdown will require more forceful and comprehensive action rather than piecemeal support. The problem is, as regular viewers know, China doesn't have much fiscal room to make such comprehensive action possible. Meanwhile, China's housing downturn also deepened further in November, extending a multi-year slump that continues to weigh on economic confidence despite repeated assurances from policymakers that support will intensify. Official data published today, Monday, showed new home prices in 70 major cities fell 0.39% from October, following a 0.45% drop the previous month, the sharpest decline in the year. Prices of existing homes, which face less direct policy intervention, slid 0.66%, unchanged from October. The persistent weakness once again shows the scale of the challenge facing China's property sector, which has been in contraction for roughly 4 years and has become a major drag on growth. Concerns have been amplified by the worsening financial stress of China Vanke Co., long regarded as an industry bellwether, reviving fears of another round of painful debt restructurings across the sector. We covered this late last week. Major financial institutions see little near-term relief. Citigroup analysts, in a note published today, warned that the housing market faces a, quote, harsh reality, end quote, in 2026, forecasting an additional 11% decline in national home sales value next year unless liquidity conditions improve. UBS's John Lamb said prices are likely to keep falling for at least 2 more years, extending the slow collapse to 6 years, noting that resale home values in large cities have already dropped by more than a third from their peaks. This would represent somewhere between 15 and 20 trillion US dollars of value lost. Fitch Ratings has projected that new home sales volumes could fall another 15 to 20% before stabilizing, keeping banks' property-related bad loans elevated into next year. The property slump is heightening anxiety among officials. Policymakers are weighing measures such as mortgage subsidies and tax rebates, and have pledged to accelerate the purchase of unsold housing stock to reduce excessive inventories. At the same time, authorities have moved to curb pessimism, ordering private data firms to halt production of sales figures and tightening controls on negative commentary. The contrast highlights the tension between policy resolve and depth of the property sector's adjustment. I often receive a lot of criticism that the channel is only following negative stories about China. This is not the case. Positive stories and neutral stories are covered as well. But the economic story has been negative for years now. China is going through a slow, painful, and likely structural decline. This means that the news is mostly negative. If that changes, then of course what we cover on China Update will change. But if official data says that fixed asset investment and property prices are in decline, I cannot produce an episode and say that they're increasing. It's simply not correct. Sometimes I receive emails saying I visited Shanghai or Shenzhen and everyone looked happy and just fine. Well, it's not surprising that you can find anecdotal examples of positive trends in some of the wealthiest parts of the country. But the macro numbers do not lie, and these are the trends we must follow. Some have also criticized that this channel is always talking about a crash or a collapse, and where is it, and you keep going on about it. But once again, if it is a slow structural shift, then by its very nature it's going to be unpacked over many months and years. The property sector continues to decline. What has happened in terms of prices can only be described as a collapse. 10 to 20 trillion US dollars of lost value is much bigger than what Americans lost in the crash of '08. Rather than happening over a few months, however, this has happened over half a decade. Like I said, this is not an anti-China channel, nor is it a pro-China channel. It is simply a channel seeking to understand what is happening at the macro level in this large, complex, and incredibly important country of China. The good, the bad, and the ugly will all be covered. If that is something that you are interested in following, I would very much enjoy you coming along as we follow this country together. Next up, China's push to dominate the energy side of artificial intelligence is reshaping the global AI race, highlighting a structural contrast with the United States. In a piece published in recent days, US-based The Wall Street Journal argues that while the US retains clear leadership in advanced AI models and cutting-edge semiconductors, China has built a, quote, decisive advantage in electricity supply, end quote, an increasingly critical input for large-scale AI development. Over the past decade, China has constructed the largest power grid in human history. Its electricity generation, the Wall Street Journal argues, now exceeds that of the United States by more than twofold. The power prices for Chinese data centers can be less than half those paid by US operators, the report says. This abundance matters because modern AI is fundamentally electricity intensive. Training large models, running inference at scale, and compensating for less efficient hardware all require vast amounts of reliable power. State-led planning has played a central role. Beijing's East Data, West Computing strategy channels energy from resource-rich western regions to data-hungry eastern cities, pairing massive investment in renewables, nuclear power, and ultra-high voltage transmission with concentrated data center hubs. Banks and state firms are expected to spend hundreds of billions of dollars expanding grid capacity through the end of the decade, leaving China with significant spare power even as AI demand surges. This energy surplus partly offsets China's disadvantages in chips. Domestic processors lag Nvidia's best products, but Chinese firms compensate by linking large numbers of less advanced chips together, a strategy that works only if electricity is cheap and plentiful. In effect, China trades power for performance. The US faces the opposite constraint. American technology companies lead in chip design and AI software, yet, the report argues, grid bottlenecks, slow permitting, and rising electricity costs threaten to cap data center growth. Forecasts suggest power shortages could emerge within a few years, turning energy infrastructure into a limiting factor for US AI ambitions. The result is an electron gap that reframes the competition. In the near term, chips still matter more than power. Over time, however, sustained access to cheap electricity could allow China to narrow the AI gap, not by inventing better chips faster, but by ensuring it can run far more of them. Now, some have pushed back against this report, however, including in the White House. In a post on Truth Social, US President Donald Trump expressed, quote, "The Wall Street Journal has another ridiculous story today that China is dominating us and the world on the production of electricity having to do with AI. They are wrong, as usual. Every AI plant being built in the United States is building its own electric generating facilities. The approvals are being given carefully, but very quickly, a matter of weeks. Any excess electricity being produced is going to our electric grid, which is being strengthened and expanded for other purposes than AI, like never before. In other words, AI has far more electricity than they will ever need because they are building the facilities that produce it themselves. We are leading the world in AI by far." End quote. Which position is more accurate, only time will tell, but the wider technology competition is only set to intensify, and we'll be following all salient developments as they happen here on China Update. Okay, that is today's episode of China Update. If you'd like to follow along as we continue to follow these spaces and others related to the world's #2 economy, consider subscribing. If you enjoyed today's episode, it's a huge help if you can just hit that like button. Patreon and Buy Me a Coffee links are in the description if you'd like to help keep the channel financially sustainable. I rely primarily on audience support to keep going, so this would be a welcome piece of support as we move into the Christmas season. Thank you so much, everybody, for watching. Have a good Monday, have a productive week, and I hope to see you for another episode tomorrow.